Right then, hello everyone, and just another update from us at the end of another week of trading. We'll start with the calendar. We'll have a flick through the calendar and see what has gone on. Tuesday night, Wednesday morning, 1 a.m. with the RB&Z, the Reserve Bank of New Zealand, with another interest rate decision. We did get told that they were going to, or we did get a terminal rate for the official cash rate, as they call it in that country, of 5.5% in September of next year. We did get told that they did mull a 100 basis point hike at this meeting, as they will go on a 3-month hiatus after this until the new year. They do have a couple less meetings than the rest of the central banks, so that shows the need or the want for them to maybe slightly get ahead of the curve, hike a little bit more, because they won't be able to do it for another few months, another 3 months. So that was a slightly hawkish statement, a slightly hawkish press conference as well. Did have a bit of upside post release, at 1 a.m. Not had much follow through, not had that much follow through, but still a little bit. And we'll have a look at markets when we get back to the charts. But yeah, that shows further rate hikes ahead. They're going to continue hiking interest rates. They've told us to expect more interest rate hikes to finish at 5.5% sometime next year. Well, not sometime next year, September next year is when they relayed, or what they relayed to market. So we'll have to keep an eye on that. But that shows a further 1.25% of hikes, which would be 525 basis point hikes. So we'll have to see where that ends up next year. But that is what to be expecting when it comes to the RB&Z. We'll flick across then down to the minutes, and really the minutes were really the only sort of high impact data apart from that on the calendar this week. Now, we did get told in the minutes, or we did get the facts relayed to us in the minutes, that the terminal rate for the federal funds rate was going to be higher than markets initially anticipated, or what was initially relayed to markets back in September in the dot plot. 4.6% is what they told us back then. It is going to be higher than that. It is likely to be up past 5%. They did say that they were undecided on the terminal rate. There was a few discrepancies in opinions on the terminal rate for the federal funds rate. So not much information on that. We're still a little bit unsure of what to expect then going forward, but the majority of the FOMC did all agree that slowing the pace of rate hikes seems to be appropriate going forward. Markets now price in an 80% chance, or money markets price in an 80% chance of a 50 basis point hike at their meeting in December. So that's what's expected for markets going forward, slowing the pace of rate hikes. Stocks like that, they were up a bit off the back of that. Dollar was down a bit off the back of that. Obviously, we've come into Thursday and Friday this week. Pretty thin trade due to the Thanksgiving holiday in the US. So pretty thin trade. Might have to wait until next week to get a little bit more direction on that sort of a thing. But we'll have a flick across the charts. You can see the dollar index has printed a few lower days, 3 days in a row, 3 down days in a row, Tuesday, Wednesday, Thursday. We can see stocks, the S&P 500 up slightly, up Tuesday, up Wednesday, off the back, or in the lead up to those minutes. Then obviously Thanksgiving, pretty thin trade, not a lot of direction to be taken in the last couple of days on that one. But cable marching higher again, and really the dollar across the board, has flicked higher. The euro dollar, a few upside days this week. Kiwi that we just spoke about, bit of a hawkish central bank, couple that with a bit of a dovish minutes from the FOMC, did have a pop higher through the highs. A couple of the other pairs aren't quite through the highs, but you can see these blue candles would not normally be green. I prefer to use them blue, but blue is obviously a buying candle, and we've seen some upside across the dollar block. And in the dollar pairs, you look at dollar yen downside, dollar Swiss downside, dollar CAD a little bit of downside over the course of this week. So that's what we've seen, off the back of a slightly dovish FOMC minutes. Apart from that, then, we've not got a great deal more information out this week. Oil was a bit in focus. I was looking at oil a good bit this morning. We've seen last weekend across China, we had 3 deaths in China across the country, first COVID death since May. Now, what that does is it sends markets, or gives markets a belief that China may re-enter some sort of COVID measures, some sort of COVID restrictions, which is exactly what we have seen into this week. And obviously, China, the world's second largest economy, the world's largest consumer of oil. So if they shut their economy down, or if they have lockdowns in major cities, well, then demand for oil then increases. If demand for an asset then decreases, naturally the price then goes down. So we then saw lockdowns. We've seen lockdowns over the last 24 hours across Beijing. Obviously, Beijing, quite a large city in China. But that is then put down to or that's then decreased demand in oil. Couple that with the fact that the G7 have proposed over the course of this week a price cap on Russian oil of $65 to $70, which does allay a bit of fears that Russia would retaliate by cutting supply. If Russia were to retaliate by cutting supply of oil, well then that should push the price of oil higher, right? The fact that those fears have then been relayed has then pushed oil slightly lower, but going forward, I think traders will remain slightly cautious on the asset going forward. There is an EU ban on Russian crude being introduced on the 5th of December, and then we've got an OPEC meeting as well on the 4th of December. So not next week, the week after, that is to be expected. So markets will probably remain slightly cautious ahead of that, but with decreased demand for oil in China and then no fears of any sort of supply cut from Russia, probably states that oil should continue to be somewhat bearish going forward. We are at a pretty big support level down at 76.50, down at 76.50. As you can see, we'll just blow the chart up just so you can see it a bit better. We can see then across here, 76.50. That's a level to keep an eye on. As if we can get through that, there's not much support really, and down until we get to kind of 66, 62, that kind of region down there, and that looks primed to break, really, doesn't it, with the news we've had this week with China entering lockdowns again. No Russia supply cuts. Maybe we will see some more downside in oil over the course of next week, but that's one to keep an eye on. I think we'll need it through that support level to give us real fresh indication that this downtrend is continuing. We'll flick back to the calendar, have a quick flick across into next week. And we do have a couple of things of note out next week. It is non-farm payrolls next week, got that on Friday. But we do have a CPI print out of Germany on Tuesday. Now, we did see PPI this week in Germany, a massive miss on expectations. Can't remember the exact figures off the top of my head, but it was up in the 40s we were expecting, and then it was down, I think 32 was then the actual figure. So big miss on PPI, on inflation for businesses. Is that likely to be relayed in the CPI print on Germany on Tuesday? Remains to be seen. We have seen inflation tick down last month in the US, but that same situation has not been universal. It's not been universal across all the countries. So if we can get a few of these other countries starting to pull back in inflation dropping in a few of these other countries, it should prove supportive for risk, and that can then provide some trading opportunities. You've got Italian as well, a bit of a lesser impact inflation print out of the Europe, but something we can monitor all the same. I think this will be one worth looking out for. Manufacturing PMI out of China, with the increased COVID measures that they are predicting as of this week. Probably not likely to be relayed in this, but any sort of weak data here is obviously not going to be positive for risk. Anything kind of above 50 might help us if inflation continues to pull back. So we got a couple of manufacturing PMI prints out of China over the course of next week, one we need to keep an eye on for any fresh impetus when it comes to global risk, or if you trade Chinese related assets, then obviously you'll have to keep a pretty close eye on that. Which brings us then to Friday. So non-farm payrolls. I'm not sure non-farm payrolls is really the important figure here. I think this unemployment rate is slightly more important. Now I keep my eyes on the unemployment rate. It ticked up from 3.6 up to 3.7 last month. This month it's then supposed to go from 3.7 to 3.8. So if that unemployment rate keeps ticking higher, right? Unemployment keeps ticking higher. That is then not a positive, but it removes what that does is it removes the need for the Fed to continue hiking interest rates, as they don't want to cause large levels of unemployment. If inflation cools down and unemployment ticks up again, well then they're going to stop hiking interest rates. They stop hiking interest rates, it's going to be negative for the dollar and positive for stocks. So that can give us some fresh trading opportunities next Friday, but a week today going to take us a little bit of time to get there, and we will cross that bridge then when it comes to it. So into next week then, may keep supportive for risk. I'll probably keep your eyes on stocks and the dollar. Dollar seems like it wants to have some downside. I'll keep your eyes on that 10-year yield for fresh direction. If that continues to continue lower, that is then is then should provide us with some fresh impetus for stocks to move higher and the dollar to continue lower. So keep an eye on that 10-year yield, keep an eye on the data into next week, and it seems like stocks higher, dollar lower is the way to play it at the moment. But look towards your charts, see if your levels are matching up, see if price matches up, and then act if price does match up. If price goes the other way, and you've got to reevaluate your thinking and accept the fact that you may be wrong. But I'm going to wrap it up there then, folks. That is it from me for another week of trading. We'll be back next week for a fresh update. Have a nice weekend, and I'll speak to you soon.